Hey everybody, we are going to talk about Nvidia today. Well, sort of. We're going to talk about an ETF that uses Nvidia to generate a lot of dividend income for its investors. As of the latest information, it has a yield of roughly 48% on an annualized basis. That might sound too good to be true, and you know the old saying, but before we dive into that, please take a minute and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It is the best way to support this work I am doing on YouTube. Again, that is fool.com/Frankel. Please go check it out. So, we're going to talk about an ETF in particular. Ticker symbol is NVDY, and I'm going to share my screen real quick. And it is there's a series of new ETFs that popped up over the past year, little over a year, called the YieldMax ETFs. Now, these are income ETFs that are based on individual stocks or collections of stocks. There's a Magnificent Seven one, for example, but most of them are based on individual stocks. There's a Tesla income ETF. There's one for Microsoft, for Apple, for a bunch of major companies. And these are, before we get into how these work, just check out the stats right here. So this is the YieldMax Nvidia Option Strategy ETF, NVDY. You can see right here there are about $550 million of investor assets in this fund. So it's not a large ETF by any definition, but it's not tiny either. These are kind of costly ETFs at expense ratio of 1.01%, which that's on the rather high end. Most index funds are in the anywhere between 0.03 to 0.25%. Again, this is not an index fund. This is an actively managed ETF. So you would expect somewhat higher, but that's a pretty high rate. The key number here, look at this yield. This is based on what the fund has paid out to shareholders, and it's almost 48% right now. Other YieldMax ETFs also have very, very high yields. So it's not just the Nvidia one. If you look at any of the other ones, some cases it might be 20%, 30%, some might be 50 or 60. These are very high yielding instruments. They might sound too good to be true, and that's because in some ways they are. So how do these work? So let me share a different screen. This is the YieldMax page. This is kind of the general idea of how this works, and then I'll explain kind of what this means. So if you see under Fund Overview, it says the YieldMax Nvidia Option Strategy ETF, NVDY, is an actively managed fund that seeks to generate monthly income by selling and writing call options on Nvidia. The ETF pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of Nvidia. So, in other words, this is a covered call ETF. Its goal is to not necessarily see the stock price rise much over time, but to take advantage of cover calls to generate current income, distribute that income to shareholders, repeat the process month after month after month. So you can scroll down on the page to its current holdings. So this is as of the date I'm recording this, which is July 2nd. And there's a lot to unpack here. You see there's some put options here that they sold that kind of, it offset. They don't actually hold Nvidia stock. They own put options, they own treasury bonds, but the real thing to pay attention to are on the bottom these four types of call options. All of them expire in a few days. So these are monthly call options, or actually they're actually weekly call options. They expire on the 5th of July. That's an off week, so these must be weeklies. And you can see the strike prices on them. These are $127 calls right there, $129 calls, $130, $131. So basically, as long as Nvidia is under $127 a share at the time of expiration, all of these options will expire worthless. The ETF keeps all the premiums it generated from selling those call options and can distribute it to shareholders, which is why that yield is so high. And if I look at a current share price of Nvidia as I'm recording this, let me just look real quick. The market's open right now, so Nvidia trades for about $122 a share. So it has declined quite a bit since they sold these options. Generally, the YieldMax ETFs will sell one series of options essentially at the stock's price or slightly above it. and a few that are more out of the money in order to kind of increase the chances that they'll be able to, some of them will expire out of the money each time. It doesn't always work out that way, especially with Nvidia, how it has increased so much over the past couple months. We'll get into that in a little bit, but that's how it works. It sells a few different strike prices of call options. When they expire, it takes the money it has and buys more call or sells more call options and generates income, and so on and so on. That's the primary objective. It's to generate income. So what does this mean to you? I'm going to get into performance in a little bit. But what selling call options does is just like if you sell a covered call on a stock you own, it ends up limiting your upside potential. If I own a bunch of Nvidia stock and I sell a call option with a strike price of $130 a share, the stock price rises to $150. I don't get any of that upside beyond 130, which for a hot stock like Nvidia can be a problem. If the stock, shoots up by 20% by the time your options expire, you don't really get that. So there's a few scenarios, and I made this a little kind of handy slide to kind of illustrate what happens. Bear with me for just a second. So there are four basic scenarios that could happen. First, Nvidia stock rises sharply, which has happened quite a bit. Your upside is capped after a small gain. Your ETF will rise slightly. Although your upside was capped from the covered calls because of the covered calls that you already sold, now more covered calls can be sold to generate income. The best case scenario is that the stock rises very slightly. So remember, it says it will cap your upside. You want to participate in the upside a little bit, but it is capped. So the best case is that the stock rises just enough so that all of your covered calls still expire worthless. The shares gain a little bit, and new calls can be sold to generate income. That's the best you can hope for. The second best, in my opinion, is that the stock is flat. Almost the same outcome. The covered calls all still expire worthless. Your shares are flat because the stock's still worth what it was. And now new calls are sold to generate more income. Now, the bad case scenario is when you have a stock that's really turbulent and the stock falls. The covered calls are still generating income. They expire worthless, but the share price drops because the stock falls. You're not capping your downside. You're just capping your upside. So now new covered calls must be sold at lower strike prices. And this can kind of create a cycle over time, making it very, very hard to get back to even. Now, in the case of the Nvidia ETF, the performance has actually been really well just because the stock has done so well. So let's take a look at a couple of performance charts that you need to see before you buy any of these. So let me quickly just share my screen again. This is the last screen share of the video, so bear with me. So here's the chart. This has only been an ETF since May of 2023. Since that time, it's generated a total return from yield and the little bit of appreciation it can use, 173% total return for shareholders in a little over a year. That sounds pretty awesome. But if you had just bought Nvidia stock during that time, you would have a total return of 329%. So because you're missed out on a lot of that upside, because you could see a lot of times Nvidia kind of spiked higher, like right here, there's this period right here. And during those times, the covered calls, finished in the money. And that caps your upside as an options investor. So it's not unique to Nvidia. There's other ones. Here's I'll show you the Tesla one. So here's just how Tesla stock has done that's forever. Since the ETF's inception, the Tesla YieldMax ETF was started in late 2022. And since that time, Tesla itself has been up by 25%. Not great performance. The YieldMax ETF has done even a little bit worse than that. And the reason for that is Tesla is volatile. Remember, I said the best case scenarios are either a slight increase in the stock price or the stock finishes flat over a certain period. And if you look at this chart really closely, that doesn't happen very often. The orange line is Tesla. Here it is spiking upward, shooting downward, spiking upward, going downward quickly, upward, downward. Not a lot of flat or mildly good periods. There, one right here, but there aren't a lot of periods that are flat or mildly good. And when you get those other two scenarios, either a rapid spike in the price or a rapid decline in the price, the mathematics of these ETFs don't favor investors. Investors would make out fantastic if the stock just rose by 1% a month over time. You're enjoying a 48% yield. The stock price never goes down. That's not the real world, though. So these are volatile stocks. It will generate a bunch of yield. If income is your priority, maybe take a nibble in one of these. But if you like Nvidia, if you like Tesla, if you like any of the stocks that are offered with YieldMax ETFs, I would just buy the stock is kind of my takeaway. Let me know what you think about this. Let me know if I'm missing anything that you could think of. Would love to have a conversation about this. Leave me some comments. I will do my best to answer any of them individually. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.